In March 2013, the government of Cyprus did something that changed banking forever. They converted 47.5% of people's deposits into stock in failing banks. And the legal framework to do the same thing in America has been sitting in federal law since 2010. What happened in Cyprus wasn't a random crisis response. It was a planned system called a bail-in, designed after 2008 to solve a political problem. How do you rescue failing banks without making taxpayers angry about bailouts? The answer they came up with was simple: use depositor money instead. The Dodd-Frank Act, Title II, gives the FDIC authority to convert deposits into equity during a banking crisis. Right now, 186 regional banks in the United States have commercial real estate exposure exceeding 300% of their capital. When those loans start defaulting in 2026 and 2027, the pattern from Cyprus becomes relevant, not as a conspiracy, but as established policy. This is Economic Pattern Vault, where we break down financial history to understand how markets actually work by studying how they fail. Each video uncovers the repeating patterns behind economic booms, debt cycles, and power shifts, so you can see what's happening beneath the headlines. If you find this breakdown useful, like the video, subscribe to the channel, and share your thoughts or questions in the comments. Let's look at what actually happened in Cyprus, because the sequence reveals the pattern. Cyprus is a small island nation in the Mediterranean with an economy built largely on banking services. By 2012, Cyprus's two largest banks, Bank of Cyprus and Laiki Bank, had become massively exposed to Greek sovereign debt. When Greece restructured its debt in 2012, Greek bonds lost approximately 75% of their value. The Cypriot banks, holding billions in these bonds, became insolvent overnight. In March 2013, Cyprus went to the European Union and the International Monetary Fund requesting a bailout. The EU response was clear: no taxpayer money. If Cyprus wanted financial assistance, they would need to raise funds internally. On Friday, March 15, 2013, the Cypriot government announced a plan. All bank deposits over €100,000 would be subject to a one-time levy to recapitalize the banks. The banks closed immediately. ATMs were shut down. Electronic transfers were frozen. Citizens couldn't access their money. For 2 weeks, Cyprus operated in a financial lockdown. When banks finally reopened on March 28, depositors discovered what had happened. At Bank of Cyprus, 47.5% of all deposits above €100,000 had been converted into shares of bank stock. If you had €200,000 in your account on March 15th, you woke up on March 28th with €100,000 in cash and €95,000 worth of bank shares in a bank that was failing. But here's where the real damage occurred. Bank of Cyprus stock, which had been converted from people's deposits, immediately began collapsing in value. Within 6 months, those shares had lost more than 70% of their value. A depositor who had €200,000 before the crisis ended up with €100,000 in cash and approximately €28,500 in nearly worthless stock, a total effective loss of around 64%. Small business owners who kept operating capital in the bank were wiped out. Retirees who had savings above the insurance threshold lost their financial security. There was no recourse, no appeal process, no compensation. The government had passed emergency legislation making the conversion legal, and depositors simply absorbed the loss. The European Union and IMF framed this as a successful resolution. The banks remained open, systemic collapse was avoided, and no taxpayer money was used. From a policy perspective, it worked exactly as designed. The cost was simply transferred from governments and bondholders to depositors. The pattern here isn't about banking mechanics. It's about how losses get allocated when a financial system faces insolvency. Historically, bank failures created a binary choice: let the bank collapse and destroy depositors, or bail out the bank with public funds and anger taxpayers. Both options created political problems. After 2008, when governments spent hundreds of billions bailing out financial institutions, the public backlash was severe. Politicians realized they couldn't repeat that approach. The bail-in solves this political problem by creating a third option: convert deposits into equity and let depositors absorb the losses. From a government perspective, this is elegant. The bank stays open, avoiding panic and contagion. No public funds are used, avoiding political backlash. The losses simply disappear into the balance sheets of individual depositors who have no organized political voice. The repeatable signal is this: when banking systems become over-leveraged and politically toxic to rescue with public funds, governments will shift losses to depositors through legal mechanisms that convert claims into worthless equity. This isn't a conspiracy, it's a policy framework. After Cyprus, the European Union codified bail-in authority into the Bank Recovery and Resolution Directive. The United States had already done this in 2010 with Dodd-Frank, though few people understood what the language meant at the time. The pattern emerges when you look at the incentive structure. Bank executives keep their positions. Bondholders often retain some value. Government officials avoid political accountability. The only group that absorbs catastrophic losses without any decision-making power is depositors above the insurance threshold. Let's look at where this pattern appears in the U.S. banking system today, not as prediction, but as structural parallel. Right now, 186 regional banks have commercial real estate exposure exceeding 300% of their capital. This means if one-third of their commercial real estate loans default, these banks become insolvent. Commercial real estate is currently experiencing significant stress. Office vacancy rates above 30% in major cities, property values down 40 to 50% from 2021 peaks, and refinancing becoming impossible as interest rates tripled. Between 2026 and 2027, approximately $1.5 trillion in commercial real estate loans reach maturity. These loans were originated when property values were high and interest rates were low. Borrowers now face properties worth less than the loan balance and interest rates 3 times higher. The mathematical result is default. When these defaults hit the 186 most exposed banks, their capital buffers evaporate. The FDIC insurance fund contains $128 billion. Total U.S. bank deposits are $18.5 trillion. The insurance fund can cover 0.69% of total deposits. If even a small percentage of the banking system becomes insolvent simultaneously, the FDIC cannot cover insured depositors with existing funds, much less uninsured deposits above $250,000. The Dodd-Frank framework already provides the legal authority for what happens next. Title 2, Section 210 grants the FDIC power to convert debt or other obligations into equity. Deposits are classified as debt the bank owes to depositors. The legal mechanism exists to convert those deposits into shares of bank stock, exactly as Cyprus did. This isn't speculation about what might happen. It's describing what the existing legal framework permits when the FDIC lacks funds to cover insured depositors through traditional methods. Here's the core insight. Deposit insurance systems were designed for isolated bank failures, not systemic crises affecting dozens or hundreds of institutions simultaneously. The FDIC can handle individual bank failures because the fund is adequate relative to those isolated losses. But when structural over-leveraging creates simultaneous failures across a significant portion of the banking system, the insurance fund becomes insufficient. At that point, the legal framework shifts from insurance payouts to loss absorption through equity conversion. The Cyprus model isn't an anomaly, it's a template. It demonstrated that bail-ins could be executed in a Western democracy without systemic collapse, setting a precedent that other jurisdictions have studied and, in some cases, codified into their own resolution frameworks. Understanding this pattern means recognizing that deposit safety isn't absolute. It's contingent on the scale of the crisis relative to the size of the insurance fund. The Cyprus bail-in revealed something about modern banking systems. When insurance funds become inadequate and public bailouts become politically impossible, governments will convert depositor claims into equity in failing institutions. This happened once in 2013. The legal framework now exists in multiple jurisdictions, including the United States. And the structural conditions that make this framework relevant, over-leveraged banks holding depreciating assets, are developing in real time. The pattern isn't that crises are inevitable. It's that when crises occur in over-leveraged systems, losses get allocated to those with the least political power and the most exposed balance sheet position, depositors above insurance thresholds. History doesn't repeat itself exactly, but financial behavior does. If this breakdown helped you see the pattern more clearly, like the video, subscribe to Economic Pattern Vault. and share your perspective in the comments. Understanding the cycle is how you stay ahead of it.